Recovery continues and the outlook for vehicle sales growth in 2011 remains positive, but challenges remain. I'm now joined by Jan-Louis Pretorius, a marketing manager at Wesbank, to discuss this further. Thank you so much for joining us today. Well, let's just start off with the actual numbers. A marginal drop when it comes to confidence levels, 5.7 out of 10 in October from 5.9 in July. That's still showing a recovery though. Interesting to note that the South African vehicle market, one of the best performing markets globally in the first half of 2010, outperforming Brazil, the likes of Japan and Germany, of course, China being the top performer.
Elena, yeah, certainly interesting. I think the findings for us from the indicator results that we released today were pretty much in line with expectations. And we've got to take into account that we've come off a low in April last year of 4.2, so it's a significant increase, and certainly 5.7 versus a higher 5.9 shows that there's good momentum in the market. Your comment in terms of our performance internationally certainly is very strong. One has to accept though probably that that's on a year-to-year or year-on-year basis, and last year was a tough year for us, so perhaps proportionately we're slightly up on the rest of the world market, which is reflective also in our export numbers. But
we've also had our own set of problems. When you're talking export numbers, we're looking at the rand-dollar exchange rate, which doesn't really make it that attractive to export as many manufactured goods from South Africa. We've also had disruptions in production lines, and of course we had the implementation of carbon taxes, which was put forward in September. So despite all this, we're looking relatively strong. Can we continue this strength?
Yeah, I think one of the advantages of our indicator is that it does look forward too. So the dealers seem to believe that that our market will continue to grow in terms of activity levels. I think with the 6-month view of 6.7 out of a possible 10 and the 12-month view up to 7.1. We have also learned over the past 12 indicators that we've released that dealers do overestimate future market activity by roughly 1 point. We believe the market will remain strong, and we would hope to achieve somewhere in the first or second quarter of next year a level of about 6%, 6 points out of 10, which will be quite significant.
Looking at the original equipment manufacturing space, we saw overcapacity a couple of years ago. We saw quite a bit of consolidation. We're seeing a very strong exchange rate at this point in time. Tell us about how the import-export scenarios are playing out, because it makes it far more viable at this point in time to start importing more vehicles and manufactured parts as well.
Absolutely. I think, as you quite rightly point out, the exchange rate is very favourable for importers at the moment. In this particular survey, we separated out the pure import manufacturers and tried to establish what their confidence levels are, and certainly they were slightly, well, not slightly, quite significantly higher than the local producers. The difference between the two is 5.6 versus 6, so quite significant. We also know that if we look at the NAMSA sales figures this year, a pure importer like AMH, Amalgamated Motor Holdings, which include Hyundai and Kia, almost constitute now 20% of the market and have seen significant growth so far.
Interesting to note as well, used cars did relatively well. So the used car to new ratio sitting at 1.9. So in other words, we're starting to see more people buying into used cars. Why is this happening? Because surely with a much stronger rand-dollar exchange rate, it should make it cheaper for consumers to buy new vehicles. Isn't that right?
Certainly an interesting trend that we've been watching over the last while. In the darkest days of the new passenger vehicle market, as many as 90% of dealers reckon that their used vehicle floors were much more active than the new. It has returned and in fact came down to as low as 45%, but in the last quarter we saw it spike back up to 61%. We believe that there are a combination of factors that drive that. The one being the stock shortages on new floors, which was caused by the industrial strike action. There's also quite a good flood of quality used car stock, which has come back from rental companies. So those are positive factors which have buoyed up the used car market.
Let's look at the consumer at this point in time. We've had a lot of good news when it comes to the interest rate front, and of course that is going to start filtering through quite extensively as household debt to disposable income still remains relatively high. We're sitting at around 78%. This of course is not really deterring the consumer at this point in time, because with every interest rate cut, it seems that most consumers are using that disposable income to purchase cars and of course to embark on spending. Do you think that trend is basically intact at this point in time?
We believe that the trend trend hopefully is recovering slightly. There certainly is some evidence that consumers out there are busy deleveraging their personal balance sheets, but perhaps not at the rate that one would look or would hope to find. So yes, that remains a factor that that will constrain growth in the new car market.
Some have questioned whether the growth that we have seen in the vehicle sector is due to the loosening of credit lines, or do you think it's because we have seen more disposable income?
It's always a challenging one, as banks, and certainly if you ask dealers, we're always falling foul of not lending enough. But I do think that there's a slightly larger credit appetite and lending appetite amongst banks, which is helping sales. But I think if you speak to many of the industry pundits, they believe that a return in disposable income is what is driving the growth in vehicle sales most.
We spoke about the outlook for 2011. Of course, there's a lot of peripheral problems that have come to the fore, which could, of course, hamper the consumer confidence levels in South Africa. For now, retail sales looking good, inflation under control, so interest rates also looking pretty good. What about monthly repossessions and how you see that playing out in 2011?
I think we're fortunate, certainly as Wesbank, repossessions have damaged our financial status and has been very negative to our business. Those have come off highs pretty much in mid-2008 and are currently at levels which we would describe as normal if one compares it to a percentage of our total book. And we believe that given the current trend that will remain going through into 2011.